Hello there. My name is Pat Tuley. I'm a partner based in Atlanta, Georgia. Our topic today is beyond buy, sell, or hold. Okay, so first off, a little ground rules background. This is not to imply that anyone that's you're all in the comfort of your offices or homes or home offices. This is so it's all safe. But this is not to imply that anybody that's participating today is looking to sell or is on the hunt for targets. We're here to talk about the direction of your business, of your small business, your closely held business, your connection to investors and other stakeholders. So while people are still coming online, I just want to give you a little background. I've been working with breweries when there were only about 4,000 craft breweries. So 2013, 2014 or so. Our firm offers a wide variety of business services that I will share in a minute. On the personal side, I'm a father of four, but I have six kids. Now that's confusing, right? Now, I've contributed it's the Brady Bunch, so I contributed the older four in the form of two sets of twins uh, to hide. And I've got two great stepkids as well. They're a little bit younger. We've got three in college now, three that are out working and contributing to society and off my payroll. Um, to hide back in the day when they were all growing up, I did a lot of cycling, enjoy the outdoors, and I learned to drink a lot. So thank goodness for craft beer. So let's talk about the firm for a minute while folks are still logging on. So start right off. Let's see how well your chat box is working. So anybody, everybody, chime in here. What does Wipfli? What is that? What does that mean? Does everybody know where? So on your screen up in the I believe up in the top right, there's a place where you can enter your comments. So feel free, chime in there. Anybody know what Wipfli means? All right. Well, I'll go ahead and break the Wipfli is actually a person's name. So Clarence Wipfli was originally from Wausau, Wisconsin, and he formed our firm almost 90 years ago. So one of our claims to fame, if you're not familiar with Wipfli, is that we are the professional services provider for the Green Bay Packers. And with our expansion in the Midwest and the Mid-Atlantic over the last 10 years or so, Wipfli now also serves as the professional service provider for the Philadelphia Eagles and the Chicago Bears. So, in addition to those three large National Football League franchise marquee clients of ours, our bread and butter is we serve over 70,000 clients across the United States, mostly middle market, closely held businesses and their owners. So companies just like you. We are spread across the country. We have 50 offices across the country and operate as one firm, sharing our knowledge and working together to help our clients. I also note here on the bottom of the slide, we're a member of an association of independently owned CPA firms called Allinial Global. And through that, we have global outreach to all of our clients, for any of our clients that are looking to expand their presence beyond the borders of the United States. In terms of the services, you'll have access to these slides. Obviously, you can come back to YouTube TV and look at these again. But just to highlight a couple of the things that we offer are outsourced services such as accounting, controller, and CFO services. Obviously, we also offer tax compliance and consulting. One service I would like to highlight down here at the middle of the middle column at the bottom is a service called Business Transition. And this is a great discussion and service to help business owners understand the life cycle of your business, the needs of your investors, the needs of your employees, how you interact with your customers and all of your stakeholders, the communities that we serve, and then ultimately to plan for one of life's eventualities besides death and taxes, and that is a sale. Everyone sells, but more on that in a little bit. So the things we're going to cover today, and we'll start off very basic and then quickly move into some of the more complicated or some of the more specific areas to our topic today. So we're going to talk about capital raising and different sources, as well as different types of investment that your investors people that want to invest in your company, your brewery, can make. Then we'll migrate into a discussion of what is my brewery worth. Okay. And we'll talk about some valuation techniques, but also talk about what makes a company or an organization more valuable or less valuable. We'll talk a little bit about managing different investors and ultimately lead to a discussion of buy, sell, or hold. Everybody falls into one of those categories. So that's the topics for today. Again, if you have comments or questions as we're going through, feel free to share those in the chat box. So for sources of funds generally, again, starting real basic here, funds meaning things that you're going to use to buy things. Okay, so we're talking about cash. What are the things, where can we raise cash for if I need to buy some new equipment, I needed some new tanks, or I'm looking to hire some people, maybe some salespeople or additional brewer. All those things take cash. So those funds could come from your personal assets. They could come from other employee owners or founders of the company that you're working with. Sometimes we see our breweries, it's one founder, but a handful of investors. Sometimes we see groups of investors and founders all working together. A lot of times you tap into friends and family that may have funds that they're interested in investing in your brewery. Loans obviously is a source of funding that many of us, many companies take advantage of. There's community support. And again, we're going to talk a little bit about each of these. You can raise money from strategic investors. So these are people that are, not necessarily just private equity or venture capital firms, but, people that have an interest in, perhaps the business that you have, but they're looking at it from a business standpoint. They want to put money and invest it, and they expect to see a return. And lastly, we see a lot of business partners that can become a source of funds, whether that's your landlord that may be willing to make an investment or give you a good deal on your lease. It could be your professional advisor, so your attorneys and accountants or other business advisors can, more or less invest in the company in the form of sweat equity or possibly in terms of, cold hard cash as well, and vendors. So yeah, I go through this list, and we just want to make sure that these assets. Again, we're talking about cash, things that I can cash that I can use to buy things or make investments. That's not to say that obviously a lot of owners and founders also own a significant stake in the stock of the company or in the investment of the company in the form of sweat equity, but you can't take sweat equity to go buy a new fermenter. So, we're going to talk about more of the other cash types of investments and sources of funds. So in terms of forms of funding, okay, just went through the list. So one of the ways that if your investors are going to invest is in the form of equity, okay, and this can be common stock, common interest in an LLC. It could be non-voting stock, common. It could be preferred stock or preferred interest. So common is generally that's where you think about we all invest in the organization. I own X percent. Everybody owns X percent, and theoretically, if there's a distribution of profits or a liquidation or sale of the company at some point, everybody gets their ownership piece. And contrast that with a preferred interest. Preferred interest is just what it sounds like, and frankly, it can take on a lot of different flavors. So it can be preferred as to capital upon liquidation, or as to distributions of earnings. It can be preferred as to, it can get in line sooner in terms of liquidate. If you were to liquidate the company, sell it, liquidate it, guaranteed returns. So, and I mentioned the preferred interest in particular. Sometimes you may have investors that they want to invest in the form of stock, but they're not, but they just want a stated return. So, they may invest, for instance, $100,000. They want an 8% return. So you're agreeing to basically give them, for their $100,000 investment, $8,000 in return each year. The great thing about a preferred stock is if you don't have the cash, you don't have to distribute anything until you are ready to declare dividends. So, the pros here, equity distributions are entirely discretionary. They're not mandated. Again, in the case of a preferred stock, they maybe have to get their money first if they have a preferred return of profits over the common shareholders, but that's only when you make a declaration or make a determination to actually distribute some of the earnings, the accumulated earnings in the company. So they're discretionary, not mandated. Like I said, those can be aligned with different stakeholders' interests. Then, so maybe a preferred interest, they're not looking for as much upside on the overall business, but they can get an 8% return, whereas for maybe some other investments they could get for investing in bonds or savings account, it's maybe a little lower rate of return for them. So maybe very attractive for them in that way. On the con side, I would say the problem with equity is it's dilutive. So as many equity for all the equity investors that you have, you're divvying up the same pie in different ways. So somebody else makes an investment, that means I own less of the company. So it's dilutive. It just means your ownership percentage when you bring in equity investments usually decreases. One thing I will mention here is, and it's in bright red at the bottom, there are significant restrictions on solicitations to offer stock. So be very careful, consult an attorney before you offer stock to anybody. The rules here, there are depending on how you offer the stock, you may be subject to SEC rules and SEC registration. So you just want to be very careful. The last thing you want to do is start offering your stock for sale and then find out that you don't meet an exemption and you have to do a filing with the SEC. And it's like being a public company. Very expensive, could derail your stock offering right from the very get-go. There are numerous exemptions from SEC registration and from different offering requirements. So once again, talk to an attorney, make sure you're compliant with those exemptions before you start talking to even friends and family about becoming investors. So switching gears to loans. Okay, what are loans? Well, loans are just, we all know what loans are. So I borrow money from the bank. Typically, they are secured, which means, if you fail to pay on the loan, the bank can repossess your real estate or they could repossess your equipment. Those are bank loans, but you can get loans from private investors too. So let's say I do have an investor that wants to invest in my brewery, but rather than investing in common stock or preferred stock, they're going to make a private loan to me. And potentially they could use that to, they might want to have the upside of, if the company is successful, to have more or less a stock interest. Well, they could have a convertible loan, which means at some point they have the option to convert their loan into stock or preferred stock of the company. So those are the private party and investor loans. And again, they can take on a lot of different forms as well. The pros is debt is not equity, so it doesn't dilute ownership. If it's two of us and we own a company 50-50, if we bring in a third investor, equal investor, my ownership goes from 50% to 33%. Everybody's does. But if instead of bringing on another investor, you and I instead go out and get a loan, we now owe the bank, but you and I still own 50% of the company. So a loan doesn't necessarily dilute ownership, absent, again, some kind of convertibility feature on a private investor loan, private party loan. The other pro is debt and leverage. So debt, using that, if you are in theory earning more on the money that you borrow than the interest that it's costing you to borrow that money, you can really increase investor returns. Once again, you have to balance that effectively, but it's generally speaking a lower cost of capital than common stock. The cons are interest and principal. Unlike paying dividends on your stock, interest and any principal that's required to be paid down over the term of the loan are contractual. You cannot You cannot skip payments without getting in trouble with the bank. So you want to make sure that you've got all those covered. The other big con, and I'm sure many of you are familiar with this, is that whether SBA loans or just normal private conventional loans with banks, a lot of times, where they want security, it may be they want your real estate that backs the loan or your equipment, but they may also look for personal guarantees from you to whereby if the loan goes bad and they sell the equipment and they still haven't covered the balance of the loan, potentially they could come after you personally for any personal assets that you have. Sometimes people will pledge personal assets as opposed to a blanket guarantee. So you might pledge a savings account, which is just additional collateral for that loan. So again, loans can be good in certain ways, and then they can be more challenging in other ways. So briefly, leases. Basically, all leases is a variation of a loan. Typically, they have minimal or no down payments. They usually have a lower monthly cost due to a balloon feature. So when I say balloon feature, when you get a lease, typically you make, you get the equipment. I don't put any money down. I make X payments. And at the end of the lease term, I don't necessarily just get to keep that piece of equipment. Generally speaking, if I want to keep it, I have to pay, I may have to pay, let's say it's a $100,000 piece of equipment. At the end of 5 years, I may have to pay $15,000 to keep that equipment. So that would be the purchase option. Well, that's effectively a balloon payment on a loan. I'll walk you through this. The pros are very same as loans. You're contractually obligated to make those lease payments throughout the term. They can, depending on a lot of you lease your buildings and your land. You could have, at the end of the term, presumably any property that you've improved turns back over to the lessor at the end of your term. Obviously, most of you would have built-in features like an initial lease term, but also have renewal options that stated increases or based upon market conditions. So again, like loans, the pros like loans are that you can leverage your investment through leases. Cash flow wise, they may be more favorable, but also like loans, payments are contractual. So just a real brief, and we won't walk through all of this here, but let's say I take that $100,000 piece of equipment that I want to finance, and let's say I got a loan. So okay, I'm doing a loan. I put 20% down. The rest is financed at 8% over 5 years. So you're basically financing the $80,000, the $100,000 less the 20% that you put down. So I'm financing $80,000 over 5 years. And if you pay off that principal, it's kind of like a car payment. If you're paying off interest and principal, even monthly payments over the 5 years, that comes down to $1,600, $1,622.11. If you didn't, so just to kind of put that in context, if you didn't make the down payment, so instead of financing $80,000, you're financing the full $100,000, same terms, 5 years, 8%, your payment goes up to $2,027 every month. So comparing that to a lease, same exact terms, okay, 5 years, nothing down, but instead of financing $100,000, effectively, I'm going to say at the end of the lease, I owe $15,000 if I want to keep the equipment, or I can turn the equipment back over if it's not worth the $15,000 to me. Effectively, that is a balloon payment. So basically, I am financing the $100,000 less the present value of the $15,000 5 years from now. And in that case, your monthly payment is only $1,820. Now, again, compared to the loan where I put nothing down, this is it's about $200 less a month in payments. And that is 100% attributable to the fact that I am not retiring the principal on that balloon payment, on that residual value of $15,000 at the end of the lease. So again, think of leases, they're just like loans. They have interest rates on those as well. But once again, you may have some more favorable features. It might be a good way to conserve a little bit of cash flow using a lease. versus using a loan. Another source of funding, crowdfunding, again, usually not a significant source of capital, but we are seeing platforms that are starting to get more and more active, basically pooling together private investors that are making investments in different businesses. So, maybe something to explore. Several of our clients have explored that. And, again, it can be a significant form of funding. We've also seen one of the other pros is just a kind of an incremental cash flow is, a lot of you do, mug clubs or founders clubs or brick campaigns or a founders wall or all these different things. People they get their name on the wall, they get a special mug. They may get a deal where, and I mean, sometimes these things are several $1,000s. They get a t-shirt, a mug, and they maybe get, free, their first beer is free every time they visit the brewery. There's a lot of different ways that we've seen breweries take advantage of this, and it can be an ongoing and pretty significant source of funding. So, something to think about there as well. The pros are it's a low cost of raising funds. You may have an ongoing commitment, though. Again, if they get a free beer every time they show up, but just something to keep in mind. So now we'll switch gears to kind of what is my brewery worth, and I bring this up just so we'll talk about there from a valuation standpoint. There's usually three different ways that you look at what is the company worth. The first is liquidation value. Liquidation value means what if I went out of business tomorrow and somebody came in and they say, okay, we've got your brew house and these fermenters and this forklift and some company vehicles, some computers. If we sold all that stuff, and then if we have any loans outstanding to pay, we pay those off. And then bottom line is what's left after I sell all of my assets, pay off all of my debts, what is left? And whatever's left, I mean, that's the liquidation value of your company. And presumably that's what you would be able to then distribute back to your shareholders. In a good situation, hopefully that's more than what they paid. But usually in a liquidation, that usually is not the case. So another way to value your company is to look at comps, comparable. What are other breweries selling for? So you want to look at, similar size, similar geographic footprint, similar business strategy, product array. It's the last thing obviously you want to do is be comparing apples and oranges. So you're usually comps can be difficult because there's probably not another brewery that's exactly like yours. But you want to look and kind of see what are breweries. I know from just following some of the more notable sales that have happened over the last 10 years, there's obviously a very wide range in terms of what people are willing to pay and accept for their breweries when you're selling kind of the whole thing. And sometimes that's dictated by, who the buyer is. We'll talk a little bit more about that in a second. The third and probably most relevant reference point for determining what the value is, what we call discounted cash flows. So we're going to switch on the next slide and talk a little bit more about that. And this basically says that, well, let's start off with this illustration. Hopefully most of us are aware of what a bond is. Okay, so let's say I go buy a U.S. Treasury bond and it's got a 10-year term. And let's just, using my loan numbers again, let's just say it's a $100,000 bond and it pays a market rate today of 5%. So that's the coupon rate on the bond, which means every year I'm going to get $5,000. My investment's $100,000. So at 5%, I get $5,000 a year for the next 10 years. And at the end of 10 years, I get my $100,000 back. So discounted cash flows is interesting. So assuming that 5% is the market rate today of a similar alternative investment, and assuming that is also the coupon rate on the bond, if you pull out your financial calculator and say, okay, I'm going to get $5,000 a year, 10 installments of that each year for the next 10 years. At the end of each year, I get $5,000. And then in year 10, at the end of the 10th year, I get my $5,000 interest, plus I get my $100,000 worth of principal. Well, if you discount every single one of those cash flows back into today's dollar using a discount rate, which in this case would be 5%, which is the market rate of interest. And miraculously, that will equal $100,000. That $100,000 discounted back to today at 5% might be 70,000. But if you add up the present value of those $5,000 payments all along the way, that makes up the other $30,000. I'm actually getting $50,000 worth of interest payments over the life of the bond, but that discounted back makes up the rest of that. So it would come right back to $100,000. So that's discounted cash flow in a nutshell. So now let's contrast that. Let's say that I'm making $100,000 investment in a company. And if same exact scenario, let's say that my company, it's a little train that could, and it's making a 5% return every year. So it's earning my $100,000 business is earning net earnings, net income of $5,000 a year, and it doesn't need to grow. It doesn't need to reinvest that. So it just pays me a $5,000 dividend every year. And at the end of 10 years, my property, it's worth, approximately, let's just say that I am able to then sell my property, my company for $100,000. We're the exact same picture as that bond. And so basically your imputed rate of return, once again, interest rates today are 5%. I'm getting $5,000 a year in a dividend, and I get my original investment back in 10 years. My rate of return on that's 5%. So contrast that with a investment in a business. So how is that changed if we're looking at a business? What could happen with a business? Well, for one thing, you probably don't start right out of the gates at, X profitability, 5% profitability. The idea is you're going to grow, right? So you're going to grow top line revenues. You're hopefully going to grow your bottom line revenues. And as that happens, the value of the company may go up as well. So this is the place where stocks depart from bonds, is that in bond case, I really don't have any upside potential if I hold that bond to maturity. I paid $100,000 for it. I get 5% a year in interest. And at the end of the 10 years, I get my $100,000 back. Well, if you've got a growth stock, if I've got an investment that is growing in value because I'm increasing profitability, increasing net income, theoretically the value that goes up. So the first year, maybe I don't get anything, but the second year, third year, let's say third year I get 5,000, but then fourth year I get 8, and the next year after that I get, my returns can keep going up and progress. And likewise, the value of my stock could progress. So in that case, making that $100,000 investment today, if I knew what the returns were going to be, my return could be a lot more than what I get on a bond. Okay. So what are the things that impact the value the most? Well, we just talked about what is the discount rate of an alternative investment. If I can invest in a bond at 5%, or if I'm going to invest in a stock that's got more risk associated with it, and my prospect is only to make 5%, you probably want to invest in the 10-year treasury. So the idea is that the stocks really ought to have a better investment potential down the road. So it just depends on what the discount rate is. What is your expected rate of return? The growth potential can be a huge driver as well. So you'd want to look and see, what is the growth potential of this company, the predictability of earnings and the resilience of earnings. So all of those things impact how valuable your company is. And again, the most normal way to look at these things is to look at these discounted cash flows. A little bit more globally, the things that drive value for the company. I'll start over here on the right side is in the blue box. Revenue doesn't drive value. Profitable revenue drives value. So it's all about, you need to make profits to drive the value of your organization, your company up, the value of your brewery. So the things that you're looking at ways to grow your earnings. You'll see, probably all have heard the word the acronym EBITDA. So that's earnings before income taxes, depreciation, and amortization. What are the ways that you can maximize your revenues and hopefully your bottom line? Well, you could offer new offerings. So you get into seltzers, or I open distilling operations, offer alternative beverages. You could move into expand into new locations, new geographies, expand your distribution. So there's a lot of different things that you could do to help the company grow that could potentially increase the value of the company. So a lot of things listed out here. The flip side of that too is that you want to de-risk, you want to mitigate the risk that you have. So you want to, this goes to resiliency. How sticky are your customers? Do they like you? Are you getting consistent repeat customers? Are you creating goodwill? Do you have significant concentrations of customers? If you've got a brand that, if you're, if you're Corona and that is your flagship beer, and somebody else comes out with a newer, better, hotter version of Corona, that might put you more at risk as opposed to some craft brewery that has lots of different, it's got IPAs and stouts and seltzers and Belgian beers and sours and all the other things. So having a diverse portfolio and lots of contributors, again, usually mitigates your risk and creates better more revenue opportunities. Having backups for key positions in your management team and your leadership team, developing contingency plans. I obviously, the last bullet here on the right, debrief, change, going back to 2019, nobody saw COVID coming, but we've learned a lot of things as a result of COVID. We've had to withstand a lot of major disruptions, not just from the pandemic itself, but then the supply chain interruptions, the shortages of aluminum cans or ingredients. We've seen, obviously, here more recently, labor shortages. We're starting to see some of that rebound a little bit, where the employment scene is getting a little bit easier, but it's still difficult. And the prices that you pay for a lot of things are significantly higher, including your cost of labor, cost of materials. So what are the things that you can do to kind of make your company less susceptible to those changing market conditions and business environment? To the extent that you mitigate that risk or minimize those disruptions, while at the same time growing revenues in a profitable way, that creates value for your company, for the organization. Very briefly. So I want to talk, we talked just a second about EBITDA. Okay, so EBITDA, a lot of times when you're doing discounted cash flows, and a different way to look at that is well, what is one, based upon my earnings today, what would somebody be willing to pay? And you're typically talking about multiples. Okay, so talking about, the S&P 500. Okay, this is the 500 largest U.S. traded companies. They're all public companies, and very, lots of data out there. You can see what the price earnings ratio is. Price earnings ratio is basically what the stock is trading at today divided by what their earnings are today, what their net income is today. So we've seen, kind of the 1 year, the averages for price earnings ratios run into anywhere between, 14 to 18, 19 times earnings. So that means for if I have a company that's per share earnings are $1, you're going to pay somewhere between $15 and $19 for one share of that stock. Okay, so that's a price earnings ratio. EBITDA is similar, but it's different. So for one thing, the price earnings ratio, when you're talking about earnings, that's after taxes, that's after depreciation and amortization, that's after interest expense. So EBITDA is a different calculation. It's inherently a bigger number because it's those same earnings before you subtract those things out. And hence this multiples, if you looked at the exact same company, its EBITDA multiple is going to be lower than you would have because the EBITDA is bigger. So anyway, just two different ways to look at that. One thing though to keep in mind, because even the investment itself, it's not all apples to apples. And the things I mentioned here is that, if you've got an S&P investment, if I own Home Depot stock or, Coca-Cola, those stocks, if I decide I want to be an investor in those, I just call up my stockbroker and say, sell Coca-Cola. it's, it's very easy. Those stocks are very liquid. So, again, the ability to convert that into cash, it can happen very quickly. Private companies, on the other hand, if you do decide that, hey, I want to sell my stock, even if you're going to sell it to another shareholder in the same company, it's going to take a while to, make that known, figure out who might be interested in buying your stock. If you're selling a portion just to somebody else in the company, again, that may happen. Maybe that takes 2 weeks or a couple months. If you're looking to sell a larger block of stock in a private company, it may take a whole lot longer to, to find a buyer for those and agree to terms. So again, those are some of the differences. You hear about EBITDA and price earnings ratios all the time. They're basically two different ways to come up with a barometer of what the company is worth. And you can do that, again, if you want to know, let's say I'm looking at EBITDA and you want to know what the overall company's worth, well, you take net earnings for the entire company times one of these multiples, again, somewhere probably in the 6 to 7%, 6 to 7 times EBITDA multiples. So everybody sells. So again, like life, death, and taxes, everybody, nobody, it's rare that you're going to make an investment in anything that you're going to hold on to forever, whether that's your house, and most stocks, most investments that you have, at some point, again, you could pass and leave it in your estate and it passes out to whoever the beneficiaries of your estate are. But normally you're selling, most every asset that we have. We sell our car, we buy a new car, sell a house, buy a new house. I decide to sell my Coca-Cola stock. So, but those sales can take different forms. And you may be in a situation where I'm going to sell the entire company, or that may be that just a one investor or several investors want to sell their shares, but we're not trying to market the entire company. So the question that I pose here is, do you know what your investors' interests are and what their investment horizon? How happy are you with your investors, and how happy are they with you? So those things, every investor, it's like being married to, if you got 10 investors, it's like being married to 10 different people. They all have different ideas about what that's like, and it's hard to keep everybody happy. So, you want to keep a real good pulse, finger on the pulse of what your investors are looking for, and have an idea about, where you may want to jump in with them. And, again, they may come to you, if they're a strategic investor, it's just hey, I love coming to the brewery and I'm an owner and there's my mug up there on the wall. They may not, they may be happy to hold on to your stock until, something else happens. They're not really, don't have an investment time horizon. You as a business owner need to understand what your investment horizon is for your significant investor groups. All right, let's jump gears here, talk about the industry a little bit. So, because this impacts the value of your company as well. So overall beer volumes, this is all obviously from the Brewers Association and Bart Watson's slides. We've probably got some of this information updated already for 2022, and then we'll learn a lot more about this at the CBC here in a couple months. But overall beer volumes in 2021 were only up 1%. Now craft was up still 7.9%. Not the same expansion and of craft beers, that we saw in the early years of the craft brewing scene, but still a healthy increase in craft in craft production volumes. In terms of brewery production by category, as you can see here, we've got the bulk of the beer that is being produced by large distribution regional craft breweries, followed by microbreweries and tap rooms, brew pubs by and large. But you'll see here the vast majority of production and sales of beer is concentrated in the regional breweries. As far as brewery counts, and again, we referenced here, back in 2014, there were about 4,000 breweries or so. Now we're up to over 9,000 breweries. So that impacts your investor relations, and it impacts how much your company is worth. And this count, again, you can see there's this very small green line at the bottom are the regional breweries. They're few by number and great by volume. A lot more microbreweries and tap rooms than, but they just don't overall contribute as much volume as the regional craft breweries do. And again, here's just the counts. Going back to 2015, from 4,800 breweries to up just over 9,000 at the end of 2021. We're seeing a lot more comings and goings of breweries. So where is all of this leading? How does the number of craft breweries and the types of craft breweries affect the value of your company? Well, hopefully, we remember it, whether from high school or college, the laws of economics and supply and demand. If there are a lot of some commodity or some type of business that are available for sale, that supply will typically drive down the price slightly. So if I can buy it anywhere and there's dozens to choose from, housing market. If I go out and there's interest rates are high, so not very many people are buying houses, and lots of people are trying to sell them. I'm a buyer. Again, there's an oversupply. Potentially, there's an oversupply of houses. It's a buyer's market. I get to kind of pick and choose. I like that house. I don't like that house. This is what I'm willing to pay. Obviously, over the last few years, it's been the flip of that. There's been an enormous demand for housing, but not near the supply of houses because people don't want them. People coming through their houses for open houses or for tours when COVID's going around. And then we had obviously supply chain disruptions in the construction industry. So the demand for housing over the last few years, by and large, starting to change now, but there's been a lot more demand than there has been supply. That drives up value. So, how does that factor into what is my brewery worth? Well, you got to look, is it again, if it's a limited sale and I'm just it's maybe one investor selling to another investor or a company buyback, if it's fairly small dollar amount of shares, again, that's probably not going to move the pricing significantly one way or the other. And it's ultimately my share of the stock of a company is worth what I'm willing to sell it for, but also what somebody else is willing to pay me for it. So it's negotiated. That's it's how we come up with the price that the company is ultimately worth. It's what somebody else is willing to pay for it. In the case of an enterprise sale, so this is when I say enterprise sale, let's take a private equity example. Maybe even if you think about like the Craft Brewers Alliance, their initial investment by AB InBev. Well, AB InBev came in and bought only they initially owned slightly less than 25% of that. So they made an investment in the company, but didn't own it all. But and they when they say we want to own 24.9%, they negotiated how much that's worth. The company sold them the shares. So you can have some of these investments, strategic buyer, private equity, your ESOP. Even going public, you don't necessarily have to sell off the entire company. You don't have to sell the entire brewery. But so that is an option. But alternatively, as an enterprise sale, this is when Wicked Weed sells to AB InBev, or when Georgia, obviously. So when Terrapin sells to Miller Coors. Those are big sales that happen. And that's a strategic buyer coming in saying, I can take Terrapin to the next level. I can make the beer, have better economies of scale. I've got better buying power. I've got a great brand that I think I can leverage. So they may be willing to pay a lot for that because they think they can take your sales and profitability from here to a whole nother level. So strategic buyers, you get our roll-ups and mergers of equals. So, saw like Canarchy, where they were, we had Oscar Blues and then Cigar City and several others. They're all kind of coming together, under the same banner with Canarchy. So, and we're starting to see those. And I think we'll see a lot more of that, frankly, with 9,000 breweries and a lot of strain from inflation and just, costs. To the extent that companies can get together and kind of pool their resources and gain some economies of scale or some buying power, that should, I think that's going to be a natural driver towards, companies and breweries kind of banding together and going at it with with a little more scale. So anyway, these are all things you could have next generation transfers. So, I may I'm going to leave my brewery to my kids or to the next generation of ownership or management. You could sell it through an ESOP, which is basically, it's where the qualified retirement plan basically buys some or all of the company. And then, as the company makes profits, it makes profit sharing contributions to the ESOP, which then ultimately allocates those shares out to the ESOP participants. New Belgium was a great example, as it had a huge ESOP at New Belgium Brewing Company. So, and frankly, it fits very nicely with the idea of independent craft breweries. You don't have to sell to, some, big conglomerate. You don't have to sell to Sapporo or whomever. That's a good way. And going public, I've mentioned that, a lot of companies do go public in the brewing space. We've seen very limited of that. Obviously, Boston Beer Company is a public company. Sam Adams, Craft Brewers Alliance previously was a public company, but not a whole lot of public companies in the space, and just not sure that. And obviously in the non-craft space, we've got lots of large public companies, but just haven't seen that people going in that direction. So that's the buy side. It's the whole side of this. Maybe I enjoy what I'm doing. It throws off. I'm running it at a scale that is commensurate with our ability to generate profits. And it's kind of like I compare this to here in the headquarters in Georgia, we've got Chick-fil-A, and they have owner operators, and they, basically you can own a Chick-fil-A. It's not an enormous initial investment compared to other, I use the word franchise. They don't consider themselves franchisees, but their owner operators can get an investment in a Chick-fil-A fairly inexpensively compared to, again, other franchise opportunities. But the corporation, the company more or less requires you to be on site. You're not going to own 15 Chick-fil-A franchises or locations. They want you, that's part of their business plan. And the same thing here. If I've got, maybe I've got a 7 or 10 or 15 barrel, I've got a scale that is commensurate, and my costs are commensurate with my ability to generate profits and get a reasonable return. That's nice. That could be a nice dividend stock, effectively, where I get a nice salary, I get a little bit of a return on my investment for me and for my other investors. And if that's what you're looking for, that's a business that could potentially perpetuate for years and years and years. Again, it's assuming no major disruption, assuming you've got a good business plan. So that maybe that's the hold strategy. The main point of this entire presentation is to think about where you are going to end up and where are your investors, employees, the communities that you serve. What's the end game for all of them, and to think about that. I quote Stephen Covey here: begin with the end in mind. Decide the path for your brewery by deciding the path with and for your stakeholders, your investors, customers, community, vendors, and employees. So that wraps up the presentation. I haven't seen any comments come through in the chat. If you do have any last minute before we sign off, feel free to put those in the chat box. And if not, I look forward to seeing many of you later this year at the CBP Connects events in Milwaukee and Charleston, as well as the CBC in May. So cheers, and thank you all for your time this afternoon.